September 15, 2008. At 1:45 a.m., Lehman Brothers, a 158-year-old financial institution worth $639 billion, filed for bankruptcy. It was the largest bankruptcy in U.S. history. By 9:30 a.m., the stock market had opened. Within minutes, the Dow Jones plunged 504 points. Panic swept Wall Street. By the end of the day, $700 billion in market value had vanished. Gone. Evaporated. But this was just the beginning. What followed was a financial meltdown so catastrophic that it nearly destroyed the entire global economy. Banks collapsed. Millions lost their homes. Retirement accounts were cut in half. Unemployment soared, and the world would never be the same. How does a housing crisis in suburban America bring the entire world to its knees? How do investments with names like collateralized debt obligations nearly cause a second Great Depression? And why did the people who caused it walk away rich while millions of ordinary Americans lost everything? This is the story of the 2008 financial crisis, the crash that broke the world. In the next minutes, you're going to understand exactly how it happened, who was responsible, and why we're still living with the consequences today. This isn't just history. This is the origin story of everything wrong with our economy right now. Here's what they don't teach you in school. In 2007, the global economy seemed invincible. The stock market was hitting record highs. Home prices were soaring. Banks were making billions. Everyone was getting rich, or so it seemed. By 2009, the economy was on life support. 9 million Americans lost their jobs. 6 million lost their homes. The average American family lost $100,000 in net worth. Global GDP contracted by $2 trillion. It was the worst economic disaster since the Great Depression. And here's the part that will make your blood boil. The people who caused this crisis, the bankers, the rating agencies, the mortgage brokers, they saw it coming. They knew the system was rigged. They knew it would collapse. And they made billions betting against the very investments they told you were safe. This is the story of the 2008 meltdown, the crash that broke the world. And it all started with a simple house in the suburbs. The 2008 crash didn't start with complex financial instruments or Wall Street greed. It started with something much simpler, the American dream. The promise that if you worked hard, you could own a home. But between 2000 and 2006, that dream became a weapon. The dot-com crash sets the stage. After the dot-com bubble burst in 2000, Federal Reserve Chairman Alan Greenspan made a fateful decision. He slashed interest rates to historic lows, down to 1%. The idea was to stimulate the economy by making borrowing cheap. And it worked, but it created a monster. With interest rates at rock bottom, mortgages became incredibly cheap. A 30-year fixed-rate mortgage dropped below 5% for the first time in decades. Banks were suddenly flush with cheap money, and they needed somewhere to lend it. They found their target: housing. Between 2000 and 2006, U.S. home prices increased by 124% nationally. In hot markets like Miami, Las Vegas, and Phoenix, prices doubled or even tripled. A house that cost $200,000 in 2000 was worth $400,000 by 2006. People quit their jobs to flip houses full-time. Real estate agents were making six figures. Everyone was getting rich off housing. But here's the thing about bubbles. They require constant inflation. The moment prices stop rising, the entire system collapses. And Wall Street had built a financial atomic bomb that depended on housing prices going up forever. Traditionally, getting a mortgage meant proving you could afford it. You needed a down payment, a stable job, good credit. But between 2003 and 2007, banks threw those rules out the window. They created something called subprime mortgages, loans given to people who had no business borrowing $500,000. They called them ninja loans. No income, no job, no assets. Banks literally gave mortgages to people without verifying they had income. Unemployed day laborers were approved for $500,000 homes. Strawberry pickers in California were getting loans for $720,000 houses. It was insanity. And the terms were predatory. Adjustable rate mortgages with teaser rates, 2.5% for the first 2 years, then it adjusts. What they didn't tell you was that after 2 years, your rate could jump to 9% or 11%, and your monthly payment could double or triple. Mortgage brokers lied on applications. They inflated incomes. They forged documents. And they didn't care, because they weren't keeping these loans. They were selling them. And this is where it gets diabolical. Wall Street took these toxic mortgages, loans that would obviously default, and performed financial alchemy. They bundled thousands of these mortgages together into securities called mortgage-backed securities, MBS. Then they sliced those up into even more complex instruments called collateralized debt obligations, CDOs. Here's how insane it got. They took the riskiest slices of these CDOs, the parts filled with ninja loans to unemployed people, and rebundled them into new CDOs called CDO squared. It was like taking garbage, putting it in a nice box, and selling it as gold. And the credit rating agencies, Moody's, S&P, Fitch, they gave these garbage securities AAA ratings, the highest possible rating. Safer than U.S. Treasury bonds, they said. It was fraud on a massive scale. In early 2007, something unexpected happened. After years of explosive growth, housing prices stopped rising. Then they started falling, and when they fell, the entire house of cards began to collapse. People with adjustable-rate mortgages hit their reset dates. Their monthly payments doubled. A family paying $1,500 a month suddenly owed $3,000. They couldn't afford it, they defaulted. Foreclosures started rising. In 2006, subprime mortgage delinquencies hit 13%. By mid-2007, they were at 15% and climbing. The default rate on those CDOs, the ones rated AAA, supposedly safer than government bonds, was skyrocketing. In July 2007, two Bear Stearns hedge funds that invested heavily in subprime mortgage securities collapsed. They lost $1.5 billion almost overnight. Bear Stearns tried to contain it, but the damage was done. Investors started asking questions. Wait, how much of this toxic subprime debt is out there? The answer, trillions of dollars, and nobody knew who was holding it. By March 2008, Bear Stearns was on the brink of collapse. The firm had $395 billion in assets. But when the panic hit, nobody would lend to them. In the world of high finance, trust is everything. When trust disappears, banks die within hours. On March 16, 2008, Bear Stearns, once one of Wall Street's most prestigious firms, was sold to J.P. Morgan Chase for $2 per share. Just a year earlier, the stock had traded at $170 per share. It was a 98% collapse. Thousands of employees saw their life savings evaporate. The Federal Reserve orchestrated the deal, providing $29 billion in guarantees. It was a bailout, but everyone assumed this was the worst of it. They were wrong. Throughout the summer of 2008, politicians and financial leaders insisted the crisis was contained. Treasury Secretary Hank Paulson said the financial system was strong and resilient. Fed Chairman Ben Bernanke claimed the fallout would be limited. They were either lying or delusional. Behind the scenes, banks were hemorrhaging money. Lehman Brothers, Merrill Lynch, AIG, Washington Mutual, Wachovia, they were all drowning in bad debt. But they kept up appearances, hoping somehow they'd survive. Then came the second weekend of September 2008. What happened over that 48-hour period would determine whether the global financial system survived or collapsed into chaos. Spoiler alert, it nearly collapsed. September 12, 2008, a Friday evening. Treasury Secretary Hank Paulson, Fed Chairman Ben Bernanke, and the CEOs of every major Wall Street bank gathered in an emergency meeting at the New York Federal Reserve. The topic, Lehman Brothers, was hours from bankruptcy, and if it failed, it could trigger a complete collapse of the financial system. Lehman Brothers had $639 billion in assets and $619 billion in debt. On paper, they were one of the most powerful financial institutions in the world. In reality, they were a zombie bank, technically insolvent, kept alive only by creative accounting and sheer denial. Over the weekend, desperate negotiations took place. Bank of America was interested in buying Lehman, but backed out when they saw how toxic the assets were. Barclays wanted to buy them, but British regulators refused. Nobody wanted to inherit Lehman's poisoned balance sheet. Paulson and Bernanke made a choice. They would let Lehman Brothers fail. No bailout, no rescue. It would be the largest bankruptcy in U.S. history. They thought they could contain it. They were catastrophically wrong. At 1:45 a.m. on Monday, Lehman Brothers filed for Chapter 11 bankruptcy. By the time markets opened at 9:30 a.m., panic had set in. The Dow plummeted 504 points, the largest drop since 9/11, but the real carnage was in the credit markets. Banks stopped lending to each other completely. The interbank lending market, the circulatory system of global finance, froze. Banks didn't know who was solvent and who was holding toxic assets, so they hoarded cash and refused to lend. Companies couldn't make payroll. Credit cards stopped working for some businesses. ATMs in some areas ran out of cash. The financial system was literally shutting down. The same day Lehman fell, another crisis emerged. AIG, the world's largest insurance company, was collapsing. AIG had sold billions of dollars in credit default swaps, essentially insurance policies on those toxic CDOs. When the CDOs failed, AIG was on the hook for massive payouts it couldn't cover. AIG had insured $440 billion in securities. If AIG failed, it would trigger a cascade of failures across the entire global financial system. Every major bank, pension fund, and investment firm had exposure to AIG. On Tuesday, September 16th, just one day after Lehman's collapse, the Federal Reserve announced an $85 billion bailout of AIG. The government now owned 80% of the company. It was the largest government intervention in a private company in U.S. history. But even that wasn't enough. Over the next several weeks, the government would pump a total of $180 billion into AIG, and the crisis was just beginning. In the 2 weeks following Lehman's collapse, the global financial system came within hours of complete meltdown. One by one, the dominoes fell. On September 14th, the day before Lehman failed, Merrill Lynch, terrified of suffering the same fate, sold itself to Bank of America for $50 billion. It was a fraction of what the firm was worth just months earlier. On September 25th, Washington Mutual, the sixth largest bank in the United States with $307 billion in assets, collapsed. Panicked depositors had withdrawn $16.7 billion in just 10 days. It was the largest bank failure in U.S. history. The FDIC seized it and sold it to J.P. Morgan Chase for $1.9 billion. 4 days later, Wachovia, the fourth largest bank in the U.S., announced it was being acquired by Citigroup in a government-brokered deal. Days later, Wells Fargo swooped in with a better offer. The chaos was so complete that banks were being auctioned off like foreclosed houses. On September 20th, 2008, Treasury Secretary Hank Paulson went to Congress with an emergency proposal. Give me $700 billion, no strings attached, no oversight, to buy toxic assets from failing banks. It was the Troubled Asset Relief Program, TARP. Paulson and Bernanke painted an apocalyptic picture. If TARP didn't pass, they said, ATMs would stop working within days. The financial system would collapse. Unemployment would hit 25%. It would be the Great Depression all over again. On September 29th, the House of Representatives voted down TARP. The stock market immediately plunged 777 points, the largest single-day point drop in history. $1.2 trillion in market value evaporated in hours. Congress got the message. 4 days later, on October 3rd, they passed TARP. The government now had $700 billion to rescue the banks that had caused the crisis in the first place. The 2008 financial crisis caused $22 trillion in lost wealth globally. 9 million Americans lost their jobs. 6 million lost their homes. The unemployment rate doubled to 10%. And yet, almost none of the people responsible faced any consequences. Between 2007 and 2010, 3.8 million foreclosures were filed. Families who had been sold predatory loans found themselves homeless. Neighborhoods became ghost towns, filled with abandoned, foreclosed properties. Meanwhile, the bankers who created and sold those toxic mortgages, they kept their jobs. They kept their bonuses. In 2009, the year after the crisis, the top 25 hedge fund managers made a combined $25 billion. That's $1 billion each on average during the worst economic crisis in 80 years. The government bailed out the big banks, $700 billion in TARP funds, plus trillions more in Federal Reserve loans and guarantees. Citigroup alone received $476 billion in government support. Bank of America got $336 billion. What did homeowners get? A patchwork of ineffective programs that helped less than 20% of struggling borrowers. The government spent more bailing out AIG than it spent helping all American homeowners combined. Here's the most infuriating part. Not a single major Wall Street executive went to prison for causing the 2008 financial crisis. Not one. Despite widespread fraud, liar loans, forged documents, ratings manipulation, the Department of Justice prosecuted almost no one. Instead, banks paid fines. J.P. Morgan Chase paid $13 billion. Bank of America paid $16.65 billion. Citigroup paid $7 billion. These sound like big numbers, but they were tiny compared to the profits these banks had made. And the fines were tax deductible. The banks literally wrote off their penalties as business expenses. One mid-level Credit Suisse banker went to prison. That's it. The greatest financial fraud in history, and one guy went to jail. The 2008 financial crisis created a legacy of rage. It's why we have Occupy Wall Street. It's why populism exploded on both the left and right. It's why millions of Americans fundamentally distrust the system, because the system failed them, bailed out the banks, and let the criminals walk free. The 2008 meltdown didn't just crash the economy. It broke something deeper, the social contract. It exposed the brutal truth that the system is rigged. The wealthy and powerful play by different rules. When they win, they keep the profits. When they lose, you pay the bill. We're still living in the world created by the 2008 crisis. The Federal Reserve's response, quantitative easing, zero interest rates, endless money printing, created the asset bubbles we see today. Housing, stocks, everything inflated beyond reason. The inequality exploded, the anger festered, and the next crisis is being built right now, on the same foundation of cheap debt and moral hazard. The 2008 meltdown was the crash that broke the world, and we still haven't fixed what it broke. If this opened your eyes, hit that like button, subscribe for more deep dives into the hidden forces that shape our economy, and comment below, what made you angriest about this story?